Este mute.
Okay. Good morning. I'd like to welcome you all to this second workshop on financing climate change adaptation. This workshop is organized by the Bank of Greece, the Ministry of Environment and Energy, and the Green Fund. Back in 2022, when we initiated this series of workshops in the context of the LIFE IP Adapted Greece project, we focused on setting the scene on adaptation finance through the discussion with actors of the Greek financial system, as well as with international organizations that already had experience in this field. During the first workshop, we discussed the role of the financial sector and the importance of stakeholder synergies, highlighted the need to bridge the insurance gap and the role of insurance in climate action financing. Also underscored both the cost effectiveness of adaptation measures and the necessity of prioritizing specific sectors in Greece, such as the water sector, given the growing challenge of water scarcity. Today, our goal is to advance the conversation by exploring specific frameworks for adaptation financing, alongside case studies from the private financial sector to offer practical insights and actionable strategies for effectively funding climate change adaptation. Without further ado, I would like to welcome the director of the Green Fund, Yorgos Protopapas, for his opening address. Yorgos, the floor is yours.
Thank you, Dora. Dear participants, please allow me to share some of my thoughts on the very interesting workshop hosted by the Bank of Greece in collaboration with the Ministry of Environment and Energy and the Green Fund, as already said. In Greece, climate resilience is usually considered a public sector issue. We all seem to recognize that even the most ambitious public budget devoted to it are not enough to face the increasing climate change impacts on our human and natural ecosystems. However, private financial sector seems to have identified a clear path towards investment in ideas that will support not only development, but development in a climate resilient and sustainable way. For us at the Green Fund and in our role as public funding institution, the exploration of such a potential is crucial. It can unlock the potential of increased budget, integrated intervention, synergetic actions, and new collaborations. I believe that such a thinking is deemed necessary in the current times of climate emergency. For this reason, I would like to particularly thank the Bank of Greece for taking the lead through the integrated project LIFE Adapting GR to organize this serious event that gives us the opportunity to meet with each other, connect, exchange ideas, learn, and hopefully identify ways to move forward in our next steps. As time is pushing for action, I would like to confirm that at Green Fund, we are open to explore new perspectives that can move things faster and more efficiently, always in line with our mission. Thank you for your attention and good luck in today's discussion.
Thank you, dear Yorgos. Unfortunately, due to an urgent matter, we will not have with us General Secretary of the Ministry of Environment and Energy. So we will proceed with without delay to the first panel. And the first panel focuses on scaling up adaptation finance. We will be hearing about the work on adaptation financing from key international organizations that through their efforts support the financial sector's contribution to climate adaptation. So for our first panel, we are joined today by Son Carmody, co-chair of the Task Force on Adaptation of the NGFS, the Network for Greening the Financial System, and executive director at the Australian Prudential Regulation Authority. So thank you for joining us today. We also have with us Gary Power, climate change consultant at the United Nations Environment Programme Finance Initiative, and Son Kidney, CEO, Chief Executive Officer of the Climate Bonds Initiative. At this point, I would also like to let the audience know that you can post questions through the chat box. You can find it on your bottom right, at the bottom right of your screen. Presentations today will try to stick to around 10 minutes so that we have ample time for questions. And therefore, we start with Son Carmody. Son will present the important work that the NGFS is doing in the field of adaptation. So the floor is yours. Thank you.
Thank you very much, Dora, and thank you to the Bank of Greece for the invitation to join today's panel session. So, as Dora said in the opening remarks, I'm here wearing my hat as the co-chair of the NGFS Task Force on Adaptation. We might get into, in the question time, some reflections I have from an Australian perspective, but my opening remarks will really focus on some of the work that the NGFS has been doing and how we've been thinking about the role of regulators, so central banks and financial supervisors in the area of climate adaptation. So in setting the scene, I'm really going to draw on the work of two subgroups within the NGFS. As Dora mentioned, I am one of the co-chairs of a relatively recently established task force on adaptation. So we formed a little under a year ago. And there's also some joint work that I'll be touching on later on that I've been doing with the NGFS's work stream focused on supervision. And maybe just to set the scene a bit, the NGFS has brought together, and it's now grown to over 140 central banks and supervisors from all around the world, having grown from a much smaller group almost 8 years ago of about 8 founding members. A lot of the work that the NGFS has done up until relatively recently is very much focused on mitigation, so emissions reduction. And the key link that we'd see there is that as prudential supervisors, we worry about risk in the financial sector, and climate presents very real risk to that sector, and efforts to mobilise a response, whether that's emissions reduction or adaptation and investment in resilience, we'd see as a key form of risk mitigation. And so it's something that we've been very, very focused on. But really the work was largely dominated on the mitigation side until relatively recently. And it was, I think, a lot of the increase in natural disasters that we've seen around the world in the last few years really prompted a shift in focus to say, well, while we still have to think about the goal of mitigation, we can't ignore the problem of adaptation as well. And maybe just to set the scene a bit, and I'm sure many of you have seen variations of some of these considerations, when we really stared into the problem of adaptation and investment in resilience, there are a number of things that we thought about. One is why there is such a challenging gap in financing adaptation. We know there's a gap when it comes to emissions financing, so mitigation financing, but it's an even bigger gap in the area of adaptation. And there's a few different drivers we'd see there. One is that there's a lot of uncertainty about how to think through the implications and benefits of adaptation. Under very different scenarios, you can get very different outcomes. It can also be quite hard to think about how do you monetize the benefits from that, which makes it hard to crowd, seen as very hard to crowd in private sector finance. There's also questions about how you actually assess the effectiveness of specific mitigation measures, partly because some of the benefits can be quite diffuse. And also there's a real time sensitivity that when action is delayed, then it can be harder to actually bring and mobilize that adaptation response. And just to throw one figure out there, we've had estimates that were fed into some of our work that the financing gap is well over 80%. And just developing countries alone, it's been estimated that the need for investment is in excess of $300 billion a year over the next 5 years or so for developing countries alone. So with that context, it was just under a year ago that the NGFS said, look, we really want to mobilise some of our thinking, and what's the role of the financial sector and what's the role of central banks and regulators to think about mobilising a response to the very real challenges of adaptation. So the very first thing we did was we produced a concept note, which was published in November last year, focused on really setting the scene, looking at some directions as to where we could take further work. And I thought I'd just share some of the key insights from that adaptation note. It's available on the NGFS website. We released it, we launched it at COP29 last year in Baku. And the way we set the risk perspective as prudential supervisors in this space is to sort of see that the manifestation of climate risk comes from quite a complex interaction between the climate hazards themselves. So that's the weather events, the heating, the sea level rises, our exposure to those events. So that's the physical infrastructure, where properties are built, what the actual exposure is, and what the vulnerability of that infrastructure and those population centres are. Are they built to standards that can resist the changes in the climate hazards, or are they set to older standards? And so really the whole theme of adaptation is targeting both exposure and vulnerability. So that can mean a response might involve sometimes simply moving from high risk locations to lower risk locations. In other times, it might mean trying to mitigate the vulnerability, whether it's might be building flood levees, hardening infrastructure, and so on. And so in the concept note, we sort of identified that there's a lot of research that points to a triple dividend that can arise from investment in climate adaptation and increased resilience. So obviously the first and most obvious one is avoiding loss and damage from those climate events. Second is that very much the response involves a lot of infrastructure development, which can bring economic development needs. So one of the things that we sort of unearthed in the discussion with a number of counterparties is this idea of thinking not just about adaptation finance, but what's also sometimes referred to as adapted finance, which is investment in infrastructure in a way that's adapted to a future climate. And so there's a real synergy between general infrastructure investment and adaptation. And thirdly, the social environmental benefits of reducing strain on communities. We identified two key areas where members of the NGFS can help foster response to these needs and foster climate adaptation. One is to really ensure that adaptation and adaptation considerations are firmly identified into the financial risk management of regulated institutions. So not just understanding the physical risks to themselves and to their counterparties, but also thinking about an adaptation response being a form of mitigation of the risks that they're facing. And as a result, we think that collectively, the members of the NGFS can effectively contribute to the scaling up of adaptation and, as I said, adapted finance to help close that financing gap. We identified a number of areas for further exploration for our task force. So that included improved metrics and tools for better measurement and disclosure of adaptation and adaptation activity, looking at opportunities to enhance policy, supervision and regulatory frameworks to encourage the take-up of adaptation, and more broadly fostering an enabling environment for adaptation. So one of the things is that no one institution or one industry can really collectively solve all these problems. It does require collective action across the public and the private sector, and so creating that fostering environment. And importantly, a bit like in a forum that we've got today, we think it's crucial to have a lot of international collaboration, sharing insights, sharing approaches. But because adaptation is fundamentally about responding to physical risks, it is inherently local. So the actions have to be local and specific to the community. And the last thing I'll touch on before I finish these remarks is to give you a bit of a pointer as to the next phase of work that we're currently doing. So I mentioned at the start that we've now teamed up with the workstream on supervision. And one of the things that workstream has published a few documents on over the last 18 months has been transition planning. So the work up till now that workstream on supervision is focused on is really about the mitigation side and the emissions reduction in financial institutions' transition plans. But following the work that we've done on adaptation, we were asked by the G20 Sustainable Finance Group to contribute an input paper to the June meeting of the Sustainable Finance Working Group this year, looking at how efforts can be mobilised to embed adaptation in transition plans. So existing frameworks of transition planning already contemplate the inclusion of adaptation and resilience, but I think it's fair to say that the vast majority of the work that's been done on transition planning here is really focused on mitigation, and engagement we've had with the private sector, both financial and non-financial, suggests that while some organisations are thinking about it, really getting adaptation into transition plans is very much in its infancy. So we've started work on an input paper that really focuses on the why there's value in incorporating adaptation and resilience considerations in transition plans, and then starting to point a pathway for the how. So how to go about including it, what sorts of approaches, how to think about metrics, targets, and this is a very challenging area, it's hard enough often to get good metrics and targets on mitigation activity, harder still on adaptation, but it's important work and we're trying to paint a bit of a direction. And so again, that will finish up with some next steps and pointers for further work. Again, it'll be international coordination, but local action. But we're hoping that that paper will be a useful contribution to the broader work on mobilising action on adaptation finance. So with that, I might pause there and I'll be happy to join in the question and answers later on.
Thank you, dear Son. We will indeed open the floor for questions at the end of the presentation. So now we will continue with Gary Power. Gary will present the UNEP FI work and especially particularly collaborative and principles like the Adaptation and Resilience Collaborative, the EBRD, the Principles for Responsible Banking Adaptation Working Group. Thank you, Gary. The floor is yours.
Thank you very much, and hopefully you can hear me well. I'm currently in Cape Town at FIX Finance and Commons Summit, which is where ARIC was initially founded. So yeah, nice to be with you today, and thank you for the opening remarks and setting, and also Sean sharing. I may build on some of those points. I mean, Sean's done some legwork here to share the figures, and I definitely want to echo the same sentiments around the climate context. I think lots of this has been covered. But global temperature average rise is still below 1.5 degrees, and we're already seeing significant impacts around climate change, and particularly the impacts on the most poor and most vulnerable. And this is anticipated to get worse. So it's really important to understand this. And I may share these links as well afterwards. Maybe the facilitators can help us. Sean reference UNEP reports. This is the emissions gap report to provide some climate context. And then we also have a complementary UNEP adaptation gap report, which is specifically focused on adaptation. And not to relabor the points that Sean raised, but building on some of the remarks or the opening remarks, approximately 2/3 of the estimated costs and finance for adaptation are in the public sector, either through domestic or international sources, because they typically have good public good characteristics, or in social or in non-market sectors. But the remaining 1/3 of financing needs exists in private financing and in areas such as commercial agriculture, water, and infrastructure. So really important to keep in mind with the theme of the conversation. And a lot of our work is around how we can support both these dimensions, both within UNEP and then also UNEP FI on the private sector side. So I wanted to share that really just to echo Sean's points and build upon them. And Sean also highlighted around the need for adaptation finance. I think one additional comment for us is that the gap is large, right? We know it's large and is a huge priority within climate finance, but also the modality of finance needs to change, right? A strategic approach to investment is required, which is why there's an initiative such as the physical climate risk work, which Sean was highlighting, and really moving from reactive-based adaptation solutions towards more challenging anticipatory-based solutions. Okay, so just some context about both around the climate context, adaptation context, and also adaptation finance. To kind of bring this all together and act as an entry point into some of the work we're doing in UNEP FI, I did just want to summarize some of the observed barriers to adaptation and resilience finance, which are also introduced. And these are non-exhaustive, right? And they're also not mutually exclusive all the time. But to try simplify this at the outset, really we see a lot of uncertainty around how to identify and qualify adaptation and resilience opportunities and measure impact. We see that there's uncertainty around how to identify and assess physical climate risk, which was touched upon. Perceived lower returns of adaptation resilience linked to finance has been a challenge. Inconsistent or unclear pathways to access public finance where necessary, either concessional finance or co-financing, for instance. And lastly, incomplete or inconsistent data availability and quality, which is a recurrent theme across lots of adaptation and resilience. So these are all the barriers and challenges that we look to address in UNEP FI. And we focus particularly on 3 programs. So the first is ARIC, which I mentioned at the outset. So this is a partnership of development finance institutions working to accelerate and scale private sector finance in adaptation and resilience. I'll give a short overview of these afterwards, but just to introduce them firstly. And in UNEP FI, we act as the secretariat and technical lead across the work streams. The second is the PRB. So the Principles for Responsible Banking, there's an adaptation working group, which is a network of global banks working to mainstream adaptation financing and increase portfolio resilience. I see Bauke is joining today. Bauke from Rabo has been instrumental in this work as a stakeholder and driving a lot of the work. So it'll be really good to hear from him. And it's great to see so many of the familiar faces on this call as well. I think it demonstrates the ecosystem nature of adaptation and how we're all pulling in the same direction on these topics. But within UNEP FI, we are the program lead across that, supporting the development of implementation methodology and guidance materials. And I'll share more about that in a few moments. And lastly is the Climate Adaptation Information and Learning Project, which we call CALE, which addresses primarily sort of information gaps right, supporting information exchange across finance actors and real economy actors through communities of practice. And that is particularly focused on Latin and Central America, Sub-Saharan Africa, and Southeast Asia. So as mentioned, it's financial institutions, so banks, regulators, and central banks, financial sector institutions, and real economy actors. So again, UNEP FI here is working to identify and lead the community of practice design and delivery across both last year and this year in the lead up to COP, and some publications afterwards as well. So that is a short introduction to each. As I mentioned, I'll expand upon each of these and just explain the work streams and the body of work about what we've published, and we'll share the references for these and also what we're doing next in the kind of same theme as how Sean approached his introduction. So ARIC, as I mentioned, was formed in 2020 at the Finance and Commons Summit in Paris. Is consisting of DFIs working to accelerate and scale adaptation finance. And we have three primary work streams in this. So the first is physical climate risk. So the work here is focused on, or last year was focused on, developing the physical climate risk investor playbook to address the barriers that I outlined previously, as well as aligning on common methodologies and approaches to physical climate risk assessment across members, really supporting interoperable risk assessment, both within ARIC and as a wider group of stakeholders. And this work is also then supporting a wider concept, which we're working at the moment, called the Resilience Challenge, which is in development under Workstream 3, which I'll introduce in a moment. But again, this publication was released in October 2024 and would encourage attendees to please take a look at this to provide guidance and work examples around how to engage on the topic. The second is around impact management and measurement. So the initial focus last year was on direct financing. So direct financing for the DFIs, how they conduct impact management and measurement, and this also applies to investors. And then there's further work around intermediated financing and also how to measure and evaluate impact within the Resilience Challenge, which I've also mentioned in the first example. Coming down to capital mobilization, the Climate Investment Playbook was released by BII and FMO in June 2024 to support investor understanding of adaptation resilience opportunities, really trying to break down that understanding around how to engage in adaptation resilience. And as mentioned, the Resilience Challenge is a pioneering initiative which is in development, designed to catalyze and scale investment in climate adaptation resilience, which is targeted to be launched later this year. So this is a short introduction to it with more to follow. So hopefully I can be back here in a future session, provide more details on this. But fundamentally, it's a framework to support bringing all these different dimensions together into a unifying investment structure, which can be applied both by ARIC and also wider members. So this is a really core focus for us. And as I mentioned, a lot of the other work streams are supporting this development also. So a short heads up on that one. So that's an overview of ARIC. I'll move on to PRB. And the focus over the last number of months and in the coming months has been around working through the previous publication, the PRB Climate Adaptation Target Setting Guidance, which was published in 2023, looking at the components of this guidance and then developing a pilot program to examine and define sort of best practice or leading practice around kind of key themes for PRB banks. So that's strategy development, client engagement and monitoring and reporting, and the associated internal policies and processes that enable implementation. So this is very bank focused, but in adaptation resilience strategy, we're looking at engagement with public policy, such as NAPs, which I'm sure will be discussed today, undertaking physical climate risk assessment, and portfolio and product strategy development, right? Kind of core components to that informs everything which takes place subsequently. You can see some of the component parts that we've outlined, which will be published later this year as part of an updated guidance. Client engagement then consists of client outreach, needs assessment and collaboration to drive positive adaptation resilience outcomes at client and systemic levels, and then also monitoring and reporting. So how to actually monitor and report back at the portfolio and client level around adaptation and resilience linked performance. So again, on this one, we expect to publish revised guidance on this in mid-2025. And thank you to all of the banks and their stakeholders for their contributions in this development so far. Lastly, is the CALE program. So as I mentioned, this is focused on information exchange and looking across finance ecosystem actors. So really extending out to the real economy, as well as having a broader reach than just investors or banks themselves into kind of financial institutions also, which I outlined. And this consists of three core parts. So the first is a community of practice, which I outlined at the intro in terms of working across the three different regions. Knowledge building, so a set of webinars facilitating and hosting physical and virtual workshops, again, to examine and discuss the challenges, barriers, and opportunities associated with adaptation and resilience, and consolidating this into a series of white papers, policy briefings, and blog posts, which is all taking place now. So I mentioned that this program started the latter part of last year, so kicking off in September, running all the way through into COP, with the publication of policy positions and recommendations and white papers, and then consolidating this into finalized outputs, communicating results into Q1 2026. So hopefully that provides a short overview about the work we're doing and reinforces some of the points around context and the adaptation finance needs today. Again, I will pause and very happy to take some questions, and if the facilitators could help me in sharing out the links. Hopefully I've kept to time, and thank you very much for the opportunity again.
Thank you, Gary. Thank you for your presentation. Excellent on time. I think we will indeed have enough time to discuss further at the end of all the presentations. So for our last speaker in this first panel, we welcome Son Kidney. Son will discuss how to reduce the financial system risk through investment in adaptation and resilience, and of course present the work of Climate Bonds Initiative. Thank you, Son, for joining us. The floor is yours.
Thanks, Theodora. And hey, what a tough couple of acts to follow. The last time I saw Sean Carmody in Baku, he did the same thing to me on the stage. Not to mention Gary's story. But look, I'll do my best to add a little bit more of a layer here. You know the challenge. We have substantial risk now in the system. We've talked about mitigation risk for years, and now we have adaptation resilience risk because climate's beginning to bite in. Frankly, people are dying because of climate incidents, climate-related weather incidents around the world. And that has not just a physical implication, which we talked about largely, but of course, as my previous two speakers have noted, social implications, economic implications, health sector implications, etc. Now, I do note that the IPCC Health Committee has been saying for some 30 years that we're going to see a century of pandemics, because that is a feature of climate change. It has been in every other period of climate change we've had before. So there was clearly a health system issue that we need to address here, learn from the last pandemic. So that's the background. But what we've been working on is the development of an extension of an existing market. So in investor circles, and our primary focus is engaging institutional investors to invest around climate. We grow on the green and social and sustainable bond market very successfully over the years. I think when we started 15 years ago, it was $2 billion outstanding, and now we're at $5.5 trillion outstanding. That's been substantial. We've done it by giving investors opportunity to invest in the debt markets that meet their risk yield requirements, and also, as an extra feature, address long-term risk around mitigation, long-term risk around policy action, and of course now, long-term risk around adaptation and resilience issues going forward. Now, I'm saying this because we do not want to create an adaptation and resilience debt market. That would be a disaster because we'd immediately have an illiquidity premium. We want to extend the existing market with its very strong demand for green instruments to incorporate resilience. Now, we've already been doing that. Something like 18% of all bonds in the green bond space now are resilient or have partial resilience in it. It's already been happening quietly under the radar. We now want to make it more visible and expand the universe of what qualifies in line with what the science is telling us, which will also allow emerging markets in particular to participate in this market in a way that mitigation doesn't really give them much opportunity. But, to be very clear, from an investor's perspective, this is all about signaling activities that can be used as a signal of reduced risk, of action to mitigate risk. That's the key thing we're trying to do in all this area. The market so far has been dominated by, first it was MDBs, non-financial corporates, and now we've seen sovereigns in particular grow. The resilience subset of the climate and green market, we expect to end up being 50% sovereign and 25% municipal or provincial bonds, state bonds, and then about 25% corporate. You get the idea of how this extension to the market will be a little bit different. Now, do note that we now have 50 governments around the world issuing sovereign green bonds. Very successful programs. They all want to expand. When I speak to them about the necessity of expanding their green funding programs to incorporate adaptation resilience, they're all saying, hallelujah, we want to expand our programs, because their biggest barrier so far has been identifying enough mitigation investments. Now, of course, that's a tension we're trying to create. We want the treasuries to be pushing other ministries to find more appropriately aligned mitigation investments, and that has been working. But we also want them to appreciate there's more to climate than just mitigation. So how have we been doing that? Well, first, we've taken the nature of the risks and we've tried to come up with a response to those risks. We've covered these things in the previous, my previous speaker's comments, but there is a closing window for us to prepare for the shocks that are coming through the system. They're coming through very, very quickly now. Remember, we are traveling in terms of climate impact at the worst possible trajectory of the IPCC some 30 years ago. The impacts are severe. So we have to work. There's a lot of vulnerable assets already being affected. Insurance losses are up, etc. We know that there are huge risks around things like agriculture, with the consequent social impact of collapsing agriculture in different areas that we've got to start address. There is a huge gap in what is needed versus what is being invested in these kinds of areas. One opportunity there, by the way, is that the larger part of what we have to do, putting aside coastal protection and changing cities, is actually the changing the procurement requirements of what we're doing now. So take infrastructure. If we're investing in infrastructure, we would be negligent if we weren't addressing future climate risks. For example, railway lines in Australia some 6 years ago buckled in the heat, 50 degrees Celsius heat of a couple of weeks in Victoria, those railway lines had to then be replaced. So if you're building infrastructure, you've got to start taking these things into account. If you don't, you're clearly being negligent. And I will say, too many infrastructure developers are not taking these things into account yet. But this is a straightforward default risk issue from an investor perspective. If that railway line can keep operating and won't even take 6 months out to relay the lines, it's going to be able to pay back its debt. And that applies pretty well everywhere. What we've been doing is working on a resilience taxonomy. We published in September of last year the first stage of a carbon bonds resilience taxonomy. Now, it looks at cities and settlements, infrastructure, but it also looks at social systems, agri-food systems, industry, health, and natural systems. Now, that's because the impact of climate change is not just physical. As I said, it's social, it's economic, it's, of course, nature as well. We need to bring these currently siloed agenda items together if we're to properly address sustainability in the context of what is going to be a century of increasingly severe volatility. The features of the taxonomy work done in line with the taxonomy work we've been doing all around the world, in Europe, in supporting China, and 50 countries around the world now have these taxonomy guidance, including Australia, that's just in the process of finishing off its guidance, has been to use multi-stakeholder approaches, science-based, and so on, and granular detail, as much guidance as we can. What we're doing in the climate bonds approach is essentially research and development for national taxonomies. The work we've done has already been inserted in the Rwanda taxonomy, is being inserted as we speak in the Brazilian taxonomy and in the Hong Kong taxonomy. In the European taxonomy, we have very general requirements around adaptation resilience, but they're very general so far. Detailed guidance has not yet become a feature. And around the world, we will see more inclusions of these going forward. The screening criteria include substantial contribution, this concept that we established in the European taxonomy, but in this case, substantial contribution to climate resilience. But we want to make sure there are no maladaptation risks. And of course, we don't want to do any harm to mitigation objectives at the same time. Fairly straightforward caveats in the program. And if you're familiar with taxonomies, you'll be familiar with these ideas. An example in water, it's the water system. It's the extent to which the water system enables other activities. Think of drip irrigation, for example, or whatever. And it's the systems such as leakage management systems that might become infrastructure of that water system. There's a wide range of measures in each sector that then become relevant. In this taxonomy, we've got about 1,500 measures we've identified that countries, companies, cities need to be considering when they're looking at adaptation, or more to the point, that they can consider and include in debt issuance programs. And this will leach across to equity investments as well. We're finding now that funds are seeking to be certified or confirmed as being in line with these sorts of taxonomies. Some examples, just to give you a bit of detail here. On the heat sector, it might range from crisis treatment for heat, or medical start training for heat, or just might be PPE, equipment localization. Because if we're going to have outages in our economy as well as pandemics, we need to make sure that we can get access relatively locally. In insurance, it'll be things like insurance of cash flows from crisis management. In nature, it'll be urban green spaces. It'll be aquifer restoration, coral restoration, which there are some programs around the world. It'll be as simple as relief funding. In Brazil, we're now looking with the Brazilian government of the extent to which the Bolsa Família has been a direct contributor to social stability. You know, when Lula was last in power, Brazil was the only country in the world that improved its Gini coefficient as a result of the Bolsa Família, the only of the G20 countries, I should say. And during that period, we started to appreciate the extent to which inequality was a driver of fragility. In fact, one of the things we now know from the last 70 years of study in emerging markets is the more unequal a society, the more, when it gets by shock, it implodes and doesn't recover. The more equal a society, the better. In fact, one of the interesting things we've learned from disaster management around earthquakes and so on is that some 40% of the death rate predictor, if you could, or let's just say, you can reduce the death rate in a crisis if you have stronger communities. The more people know each other, the lower the death rate, and the better a community bounces back. And that means from a economic resilience factor, you want to encourage community resilience. You want to, San Francisco has gone so far in terms of its earthquake program of funding neighborhood parties to ensure everyone knows each other. So if there is an earthquake, people will save each other and help each other. There are various measures like this. The participation of women in society is a predictor of reduced inequality. And in fact, it's also something terribly important for Sean Carmody in a regulator, because we know that in emerging markets, the participation of women in the workforce, which is determined by the primary education of women, leads to many more microfinance loans going to women. And what do we know? The default rate amongst women in emerging markets is about 3% for microfinance loans. Amongst men, it's 20%. So if you're a central bank or a regulator concerned about financial stability, you have an interest in the primary education of women to give you a crop of folks you can lend money to that will be much more financially stable going forward. And that financial stability is something we're concerned about in the context of volatility. You can see how all of these measures come together. It gives you a flavor of what we're teasing out. Next, for us, the deepening of guidance. We've started the process of getting more detailed guidance a la the taxonomy work that's been done in Europe or in Singapore or in Hong Kong to flesh out that 1,500 areas of guidance, thresholds wherever possible, maybe more detailed process requirements and so on. We will see this year the beginning of demonstration debt issuance using the new taxonomy. The Brazilian government, the Tokyo metropolitan government are already wanting to issue in this area, and we expect to see that grow quite quickly. So we'll be promoting debt issuance in line with the guidance while we're developing more detailed guidance for the future. We don't wait. And then the last thing is that you're going to see a lot of work on national resilience investment plans now, starting this year. For example, we expect to see some of this from Brazil in time for the Belém COP. And we'll be doing some work bringing countries together with investment pipelines, mitigation, and resilience, especially in emerging markets, to meet investors to promote this idea of this large universe of investments, an idea of what the characteristics are that are fundamentally lower risk. In this work, we've had UN Disaster Risk Reduction involved, UNDP, UN Women, various development banks, and so on. This is a realistic way to grow preferential debt issuance programs in a way that properly meets the risk issues that are now emerging, becoming serious, becoming pertinent. and doesn't just deal with water issues and coastal protection issues, but deals with a wide range of issues that need to be addressed if we're going to make our societies, our economies, our nature for that matter, resilient in the faces of the crises that are now going to become endemic in the 21st century. A lot of opportunity for Greek sovereign debt here, by the way, Theodora. Thank you.
Thank you. Thank you, Son. Thank you for setting up, the scene for the next discussion. You gave us a lot to think about, especially on your work on resilience taxonomies. So moving now to the questions, I think I would like to start with Son Carmody, opening the floor. Now, I think you did mention as well, Son, at the beginning that you would give us some more insight on what you do in Australia, what are the challenges in Australia, and maybe steps being taken there in response to improving resilience?
Sure. Look, Sean's already mentioned that one example of a climate-related challenge for Australia, but it's a big country geographically, and we have all sorts of weather and climate-related challenges, whether it's heat, whether it's fires. But one of the ones that's most significant from an insurance point of view, and the one that's also the biggest growing insurance protection gap, is actually floods. So particularly in the east coast, sort of northern part of the east coast of Australia, subject to quite significant flooding, some of which is associated with cyclones, but can be from broader rainfall as well. And what that's seen is, there's growing numbers of the country where just simple home and contents insurance is out of financial reach for many people, because insurers are price for risk quite well, and one of the things about insurance that you can think of it as essentially providing a pretty good price signal of risk, and so it's useful to then think about, well, how do we respond to that price signal? And one of the interesting initiatives that was started sort of about a year and a half ago, or a bit more, in Australia, was that for a long time the insurance industry, would get criticism for how high premiums we're getting for insurance policies, and they would consistently say, well, we really need government investment in resilience, and that's really what's going to solve the problem, that the industry can't solve it by themselves. And finally the government sort of started to, I suppose, listen in a lot of ways, and establish what was called the Hazard Insurance Partnership. So that brought together a number of government agencies, including a relatively newly established agency called the National Emergency Management Agency, which, amongst other things, has been given quite a significant funding budget for investment in resilience. And the idea of this forum that was pulled together, that brought together government private, public sector, but brought a lot of insurers to the table, including the industry group, the Insurance Council of Australia. And the idea was to have dialogue, input from the industry, to try and help direct a lot of the efforts towards things that would actually have a downward impact on insurance premiums. Now, there are a lot of things that you might do that might be worthwhile, that could have absolutely no impact whatsoever on insurance premiums. And I'll give you an example of that. Would be, if you're in a flood-prone town near a river, an example of one of the projects that was funded was to build an evacuation centre further up high ground, up a nearby hill, which could absolutely save lives. It gave some, when the town was cut off, it gave somewhere for people to escape to take shelter with, facilities, heat, toilets, and so on. Now, that's a very valuable investment, but if there are properties that are the things that are insured are still underwater, it's not going to do anything for their insurance premiums. So it's a worthwhile measure, but it doesn't actually respond to that. So by working together with the insurers, they could identify strategies. So what are the interventions that are most likely to actually help with insurance premiums? And so there's been a lot of work on sort of mapping flood regions, identifying flood mitigation plans, where there could be investment in sort of levees to redirect river water flows, move it away from towns, that sort of thing. But I think it's a really interesting example of the fact that to respond to these challenges, you really need to mobilize a lot of different parties, so private and public sectors, to really have the biggest impact. So still early days, but I think that's a really encouraging development to bring all of those together.
Thank you, Son. Let me take a few moments to share with you some of the comments we're having online. So first comment from Taike Investments. Agriculture sector needs a lot of attention from private sector and supply side measures. Invest in decarbonizing food supply chain through renewable energy, where can bring down food inflation significantly. Also, central banks to introduce climate risk-linked inflation targeting to avoid climate-induced food inflation. Another comment that we have as well is from Ofiteka, because it goes with to Son Kidney comments that it's not just self-awareness. What's happening is in a threatening situation, it is building community awareness, keeping an eye on neighborhood phenomenon and building resilience. Thank you, Talia, for that. And we have another question, which may all of you would like to address. How do we compete for investor attention in a market of tech, crypto, and other fast returning sectors? From Piraeus Bank. Thank you, Paola. Thank you for your comment. Now, would any one of you like to respond to any of those comments?
I'm going to tackle the last one. Apart from saying building community awareness, yes, yes, yes. Stronger communities will help us survive. Weaker communities will see us collapse. That's the key lesson we need to learn. But in terms of raising capital, look, fast money has always been fast money. Nothing special about it. Institutional money that dominate the bond market, that own everything in the world, is institutional money. It's after security of return, not just rapid profits necessarily, because they're forced to allocate money to be able to pay Sean Carmody's pension when he finally retires in 20 years' time. And so they have a different investment profile requirement, risk yield requirement. They're the ones talking now. The whole challenge of doing it. It's not going to be a small SME raising that money. It's going to be the Bank of Piraeus raising the money. But there is certainly a lot of opportunities. That sector, at least the investors I speak to in Europe, in Japan, in the US and Canada, are becoming acutely aware of climate risk as a filter on top of the portfolio requirements. You will, as you currently do in the green bond market, you will get more access to investors. You will get oversubscription. You'll get other benefits. In euros, you might get a little bit of price benefit, but you'll certainly get stickiness. So access, which is the main thing that concerns most people, increased, improved, richer access will come through showing that you're addressing these risks. And that has a flow on to other kinds of investments like equity and so on. People are now looking for signals that you're taking action. If you don't have any signals, to quote one Swedish institutional investor, well, is there something wrong that we need to understand if you're not doing this sort of stuff and telling us what you're doing? That's becoming the default position. So if there is definitely a lot of opportunity to get investor interest in all of this. But of course, we will always depend on the risk bridging work, on the technical assistance work of folks like the European Bank of Reconstruction and Development. And I'm looking forward to hear what Maya says in the next session.
Thank you. Thank you, Son. Also a question to Gary, if I may. At UNEP FI, how do you see your work evolving, Gary, in the future? And do you envisage any further synergies among actors of the financial system to scaling up adaptation financing?
Thank you. I mean, yeah, just interesting Sean's points around the sort of access to capital. I would just echo all those points. I think for us, we have the three primary programs which we introduced because we think that gives us this spectrum of financial actors to engage with and dedicated programs to drive some of the necessary change to mobilize finance. I think the additional thing that I haven't mentioned is the V20, which is a really important facility. I can share a link to that as well, which is supporting most vulnerable countries most impacted by climate change and requiring adaptation resilience financing. So that's another key focus for us. But a lot of it is partnership, and it's partnership with the banks, as I mentioned, it's partnerships with the DFIs, and then also moving into the real economy actors and MSMEs through the CALE program. So it's not a case of more of the same. It's just each of those programs is evolving over time as the needs evolve. So Would just encourage everyone to get in touch, and if there's anyone that we can do or anything we can do through the Kale program to connect any of the actors in this group, very, very happy to do so.
Thank you, Gary. We do also have a question on the work of the Bank of Greece on adaptation to climate change and measures that we are helping to implement. I would lead everyone on the conceptual note on adaptation of the NGFS work. There we have a case study on the Bank of Greece. So it will be on the links that we will be sharing with the audience at the end of the sessions, along with the work of the NGFS and the link for the report that Son mentioned already. And we do have another question from Professor Xepapadeas to Son Kidney, whether we have any information regarding the greenium of the sovereign bonds. Can we discuss that question, please, Son?
Sure. Well, I always start off by saying, if you're only concerned about the greenium, you're in the wrong game. It's not certain. It may disappear. But one thing that won't disappear is deeper and richer relationships with your investors. When KfW started issuing their bonds, no greenium, nada, but they got phone calls from the investors there thought they were rusted on. Stickiness is the word KfW used for the richer relationship with their investors, which of course translates into the ease of debt issuance in the future and potentially pricing. Greenium requires you to have comparison. That is, you need an ordinary and a green bond beside each other. It's quite hard to tease out sometimes. However, what we have seen happening in EUR and USD is a fairly consistent, modest greenium, not on the basis of sentiment. In the secondary market, something about 8 years ago, we started seeing very distinctly different performance for green bonds versus ordinary bonds. Whenever there's a downturn in the markets, green bonds hold their value. Whoa! You remember that quote from Larry Fink from BlackRock? He didn't make money giving his investors yield. He made money making sure they didn't lose their money. Fixed income investors, institutional, are first of all defensive because they've got to make sure they pay that pension of Sean Carmody's in 20 years' time. So that idea that this is a premium product of the secondary market has taken root. We typically see, let's say, German green bonds trading at about a 5 basis points benefit in the secondary market. Ditto European Union green bonds. The more extreme is the Egyptian sovereign that was trading at 75 basis points premium for a while before the IMF came in and everything went a bit quiet. So you get that kind of thing. So in the secondary market, you get hedge funds buying it, trying to buy it primary, just they can flip it to the secondary market, make it margin. You've got a downward pressure on primary as a result, and that means you get, well, at a European AAA green bond, you get about a 2 basis points benefit on average greenium, we'd like to call it. And it's a higher percentage at different rates. The Indian green bond in domestic rupee currency, where we'd never seen price benefit for, got 6 basis points benefit, etc. The Moscow City Metro Extension bond was $700 million in rubles, got a 20 basis points greenium in full. That was before the war started. Things have probably changed since then, but you get the idea. Is it consistent? Not always. EBRD sometimes doesn't get a greenium for its bonds. And that's probably because Isabel Laurent, the treasurer, is tough and drives a tough pricing. But it depends on treasurer action, depends how you go to market, depends that day. But we would estimate that in about 80% of time in liquid currencies, people are getting a greenium. I hope that's a full exposition for you.
Thank you. Thank you, Son. So we are reaching the end of this first session, but before wrapping up, I would like to invite all three of you, Son, Gary, and Son, maybe to share with us one key message that you would like to pass on to the audience before closing the session.
Okay, I'm happy to jump in first. So look, that last question about question earlier about the tension between crypto and other things just made me think that one of the comments we'd often have about adaptation finance is this concern that, well, won't that redirect effort or financing away from mitigation. And I think probably the one message I would leave is that when it comes to mitigation and adaptation, it's not an either or, it's got to be a both and, because we need to keep work on the mitigation and the effects of climate change are here and real. And so we need to really do both.
Thank you, Sean. Gary?
Just very quickly, I mean, our work is focused on providing the guidance and methodologies to engage on adaptation and resilience financing, as I mentioned, across that range of stakeholders. I think we have produced some really valuable and interesting material so far, a lot more in the pipeline for this year, as I mentioned. If people do see gaps, very interested to understand what those gaps are and engage with us so we can start to identify and work out pathways to addressing them. So very happy to share an email afterwards and have any further conversations. But thank you for the time again and appreciate it.
Thank you, Gary. Son?
We've been incredibly successful in the last 70 years on this planet in creating large savings pools. This is one of the achievements of economic development since World War II. Huge pools of institutional investment capital around with long-term horizons, let's just say a hell of a lot longer than our politicians as a rule. And they are becoming acutely aware of what are long-term risks, supported by groups like the NGFS and central banks who are really grappling with the issue and sharing the knowledge and so on and so on. So we have appetite. We've got proof of that appetite in the green bonds market, which is growing stratospherically. Think of it as a proof of concept of investor appetite. There are rules. You can't give them stuff which is going to have a huge discount because they've got short-term regulatory requirements as long-term. But the demand is there, the appetite there. The biggest problem we have in every market in the world in green and social bonds is supply. Getting more bonds into the market because of the nature of demand. The adaptation and resilience is ready-made now. We can make this work by increasing the market, increasing the liquid market in a way which we must, is essential if we're going to create any kind of vaguely reasonable future for our kids. And we've lost the last 50 years. That world is not going to exist in the next 50 years. It's going to become difficult and tough. But if we prepare now, we can make it workable, and we can certainly get it funded.
Thank you. Thank you all for participating in this first session. Thank you, Son Carmody. Thank you, Gary Power. Thank you, Son Kidney. It has been a pleasure having you with us today, and we're looking forward to a next discussion, maybe at a forthcoming workshop. It is a series after all. Thank you all so much.
Thank you. Goodbye.
Thanks very much.
And now we are ready to move on to our second panel, focusing on practical approaches to financing adaptation. The title is Financing Adaptation in Practice. So in this session, we will have with us experienced banking professionals that will present concrete examples of how climate change adaptation initiatives have been successfully financed, offering insights that can promote the discussion in the domestic but also international financial sector to develop similar financial instruments. So we are joined today by Panagiotis Tournavitis, Chief Executive Officer and Executive Member of the Cooperative Bank of Karditsa, and Vice President and Member of the Executive Committee of EBRD. Panagiotis, welcome. Also, Maya Henriques, Director at the EBRD, the European Bank for Reconstruction and Development. Welcome, Maya. Nice to have you with us today.
Hi, good morning, Theodora.
Eleni Iotti, Senior Advisory Coordinator at the EIB, the European Investment Bank. Welcome, Eleni.
Hello, Theodora. Thanks.
And of course, Luc de Vries, Advisor to the Board of Public Affairs at Rabobank. Good morning, Luc. Nice to have you with us. So we will start today with Panagiotis. Panagiotis will take us through some of the projects on adaptation at FEBEA and the important work of the Bank of Karditsa at a crucial area in Greece. Panagiotis, thank you. The floor is yours.
Good morning to you all. It's really a pleasure being with you today, and I would like to thank the organizer and you, Dora, for the great honor to present, and also congratulate you all for the great initiative. It's really very, very important. And sorry, man. So in today's rapidly changing environment, I don't know if there is a change in the presentation. In today's rapidly changing environment, the risks posed by climate change are more evident than ever. Extreme weather events, long-term environmental shifts are challenging our communities across the globe, making adaptation projects critical for building resilience and ensuring sustainable development. Our bank is characterized by a deep-rooted commitment to local community development, a strong financial performance underpinned by sustainable growth, and also a forward-thinking approach in managing risks and embracing innovation. At Cooperative Bank of Karditsa, we are not unfamiliar with climate change and natural disasters, but we are also proud to demonstrate our own resilience. Despite the recent tremendous floods that we had in the last 3 years, our total assets continue to expand, and our profitability remained at high levels, a true testament to our robust risk management and unwavering commitment to our community. Financial institutions like ours, with strong capital and liquidity reserves, are uniquely positioned to support adaptation initiatives by providing tailor-made financial solutions. But we have to have in mind that climate change is no longer a distant threat. It is impacting communities now with extreme weather events, resource scarcity, and heightened vulnerabilities. From an economic perspective, investing in adaptation projects can yield significant long-term savings and reduce future risks. However, traditional financing methods often fall short when addressing the unique challenges of adaptation projects. This gap necessitates the development of innovative and tailored financing solutions that can meet these specialized needs. Founded in Brussels in 2001, FEBEA stands for the European Federation of Ethical and Alternative Banks and Financiers. It is an international non-profit organization that brings together 32 financial institutions for 17 European countries with the aim of developing ethical and social finance in Europe. FEBEA brings together different financial organizations driven by the values of ethical finance. FEBEA is always at the forefront of sustainable finance, dedicated to addressing the financing gaps for adaptation projects. Our core mission is to create and promote innovative financial instruments that cater specifically to the needs of climate adaptation by forging strategic partnerships with public institutions, private entities, and community stakeholders. FEBEA is building a robust network that supports sustainable development. The vision of FEBEA for empowering communities while ensuring economic sustainability aligns closely with our bank's long-term goals. FEBEA's approach includes a variety of innovative financing tools such as grants, low-interest loans, blended finance, and risk-sharing mechanisms. These instruments are specifically customized to suit the scale and unique challenges of individual adaptation projects. By designing products that mitigate risk for both investors and borrowers, FEBEA is able to mobilize private sector investments and bridge the financing gap. This creates I think, a win-win scenario, fostering sustainable projects that are financially viable and, on the other hand, socially beneficial. But as FEBEA, we don't just talk the talk, we also walk the walk. And I would like to present the Mount Resilience Project, a pioneering initiative focused on enhancing resilience in mountainous regions. Mount Resilience Project, an ambition initiative dedicated to accelerating transformative climate adaptation for higher resilience in European mountain regions, highlighting why mountain areas are critical for climate adaptation efforts and how can we make a meaningful impact. So, Mount Resilience is a large-scale initiative funded under the Horizon Europe program, especially under the mission on climate adaptation, led by the University of Milan. It brings together 47 partners from 13 European countries. Over the next 54 months, from September 23 to February 28, we will work to develop and implement practical solutions for climate adaptation in mountain areas. With a total budget of nearly 16 million, the project represents a significant investment in ensuring the future resilience of Europe's mountain regions. The primary goal of this project is to support European regions and communities in mountain areas by increasing their capacity for climate adaptation. We will achieve this by developing, testing, and scaling up innovative climate adaptation solutions that can be applied across different regional and local settings. By doing so, we aim to foster a transition towards climate resilient societies that can withstand the environmental and economic challenges posed by climate change. Mount Resilience adopts a comprehensive approach that embraces the diversity of European mountain regions. Every region has its own distinct physical, socioeconomic, and cultural characteristics, and our goal is to ensure that adaptation strategies are tailored to these unique contexts. By integrating a wide range of perspective, knowledge, and experiences, we will create a portfolio of solutions that can be reapplied in different regions across Europe, maximizing their impact and scalability. To achieve real impact, adaptation solutions must be adaptable across different contexts. So Mount Resilience is built on these three key principles: a place-based approach that ensures a just transition, transformative adaptation strategies that go beyond incremental change, and a strong conceptual foundation that integrates scientific, social, and economic perspectives. This will ensure that the solutions developed through this project can be effectively scaled up and implemented across diverse European mountain regions. The project is structured around 6 key work packages, each addressing different aspects of climate adaptation. These include the co-creating and testing over 53 adaptation solutions in 6 mountain regions, developing a conceptual model for climate resilience, establishing a collection of nature-based and social innovation solutions, setting up a replication lab and a community of practice, and creating a Mountain Adapt Academy for capacity building. Together, these initiatives will ensure a holistic and effective approach to adaptation in mountain areas. But this project is not just about research. It is also about action. Our work will support 6 mountain regions in implementing and testing over 53 climate adaptation solutions. These will include nature-based solutions, social innovation approaches, and financial models that make adaptation both practical and sustainable. Furthermore, our efforts will contribute to policy recommendations, business models, and financial instruments to ensure long-term sustainability and scalability. One of the most innovative aspects of Mount Resilience is its focus on financing climate adaptation. FEBEA brings a unique ethical finance perspective on the project, and it will contribute by developing innovative private funding methods for climate projects, which will be tested in Romania and Austria. Additionally, FEBEA will help design financial solutions that facilitate long-term sustainability investments, leveraging both public and private funding sources. Adaptation projects deliver multidimensional benefits. Economically, they help reduce long-term costs, enhance productivity, and mitigate risks associated with climate change. Socially, these initiatives improve quality of life by empowering communities and creating new job opportunities. Environmentally, they promote sustainable resource management and help carbon degradation. Mount Resilient projects provide a tangible example of how these benefits can be achieved. Its success not only demonstrates the viability of adaptation financing, but also offers a blueprint for future projects in similar settings. So looking ahead, there are several exciting opportunities for collaboration. We can explore partnership prospects alongside with FEBEA members for co-financing or joint venture initiatives. One strategy will be to launch pilot projects that mirror the successful Mount Resilience model, allowing us to refine these financing tools in a real-world context. Additionally, investing in capacity building to develop customized financial products will further solidify our position in this emerging market. And ultimately, our long-term vision is to foster a resilient community framework that supports sustainable growth, benefiting for the bank and the communities that we serve. While the opportunities are significant, we must also acknowledge the challenges ahead. Market uncertainties, difficulties in accurately measuring impact, and navigating regulatory and policy hurdles can complicate the financing process. However, these challenges can be mitigated through proactive measures by establishing robust monitoring and evaluation frameworks, engaging closely with policymakers, and leveraging public-private partnership. We can overcome these obstacles. These steps will not only ensure transparency, but also build the credibility needed to drive forward this innovative financial solution. To move forward, I propose a series of next steps. In the short term, we should explore pilot projects and conduct feasibility studies to test their adaptation financing tools. Engaging directly with FEBEA and its members to tap into expertise will be crucial. And putting in a conclusion, I think that FEBEA and its members are at the forefront of developing innovative financing tools that address the urgent need for climate adaptation. Mount Resilient Project has provided us with a concrete example on how these tools can transform challenges into opportunities, improving community safety, reducing vulnerabilities, and stimulating local economies. Thank you very much, and I will be more than happy to take any questions afterwards.
Thank you. Thank you, Panagiotis, for the excellent presentation and the work that you've been doing both at the Bank of Karditsa and at FEBEA. We will again have some time to take Q&A at the end of towards the end of the session. So now I would like to move to Maya Henriquez. Maya from EBRD will discuss today the work of the EBRD on adaptation financing and talk to us also about case studies and examples of financing. Maya, the floor is yours. Thank you for joining us.
Thank you very much, Theodora. And I do not have a presentation. I will tell you a little bit about what we do at EBRD. And I'm not doing this for a cheap act of self-promotion, but because I think as financial institutions, we really have a lot to learn from each other. And you may probably know that EBRD is a highly private sector focused investor. So we invest about 70 to 80% every year in private businesses, private financial institutions, private capital. So all the difficulties and the barriers that we've heard in the first part of this, in the first session about adaptation finance, we have definitely experienced them. And so maybe by showing you a little bit what we do, that can also serve a little bit as an example of how a financial institution can start tackling adaptation finance. First of all, huge thank you to Bank of Greece and to you, Theodora, for organizing this. This is super important to keep talking about adaptation finance. We've heard also before what the needs are. They're massive. We've also heard what the urgency is. It is also massive. I don't need to tell you in Greece what the climate risks are that your country is facing. I'm sure a lot of you have quite painful memories from wildfires in Evia 2021, more record-breaking fires 2023, severe floods in Skiathos, in Volos, in Kefalonia. So I think you feel the pain already. I think there's also not really much to say about a trade-off between mitigation and adaptation finance. It was previously hinted at. I think we really have to pursue both. Mitigation finance, we have to continue really strong to push for it because it helps us to keep the need for adaptation finance lower. And of course, the adaptation finance we need it because we're not where we are with mitigation efforts. So we need to adapt and we need to protect and we need to increase the resilience of our communities. At EBRD, we are deeply committed to climate adaptation. We also have, as I said, experienced that it's not quite easy to do when you're operating in a private sector setting. But we've also seen our work is very diverse. We work in countries from Western Morocco all the way through to Mongolia. And every country, every sub-region, even every locality has its own very unique climate challenges. And so we do engage with both private but also sovereign clients, of course, to provide finance to the real economy, but also we work a lot with financial institutions who we've seen are very important, really actors of change in the climate action work that we need to do. So we at EBRD, we finance mainly, our adaptation solutions are mainly wired around two pillars. One are more sort of structural, sort of hard engineering measures that we finance for our projects, and the other side is more non-structural or soft climate risk management engagement strategies. Both are super important. The structural measures are, of course, things like flood defenses, water efficient irrigation systems, heat resistance, and so on. And then more non-structural or soft measures are support for financial institutions or corporates to undertake climate risk assessments, establish early warning systems. And of course, we also heard it previously several times, there's still a huge need for capacity building out there because climate adaptation is a very complex topic. Climate adaptation related data comes from a plethora of sources. It's very difficult to obtain, to read, and so on and so forth. So we want to help with that. What we've realized is obviously adaptation finance is super localized matters. It's very context specific. So as a principle to our work is really, we let ourselves be guided by a very local and context specific thinking. And that allows us to address climate risks that are really projected to increase under very relevant and very specific climate scenarios. And then the second principle is, as I've said before, it's not only to mitigate potential harm from climate hazards, it's also to allow businesses and economies to recover more quickly when they're hit by climate shocks. So trying to capture all of that in one investment is difficult. We've tried very hard. We've done about 4 billion euros of adaptation finance since 2011. 1 billion we did last year in 2024. That was really a record for us. And we've learned a lot last year, not only by finding sort of opportunities for adaptation finance, but also how to mainstream it and how to scale it up and how to do more of it more consistently. Our main ways how we do adaptation finance is through, as I said, financial institutions. And the second one is direct investments, where we invest directly in companies. So maybe just to give you a few ideas how this looks. So for financial institutions, we really work with our partner financial institutions in two ways. Together, they are disseminators of climate finance. So we can on-lend to them for adaptation needs, and they can then provide loans in smaller ticket sizes, for example, for adaptation investments. But FIs are also really disseminators of climate expertise. And we've seen a huge growth journey over the last years from financial institutions that have started maybe dabbling a little bit with climate finance 5 to 10 years ago, you know, very standard small scale renewable energy, maybe energy efficiency investments, but have now really created a wealth of knowledge when it comes to climate data, climate opportunities, and also the business case for climate action. So we really engage with them to do both things. The knowledge and the finance goes together. What we also do in our work with financial institutions is through a lot of capacity building products, but also very practical tools. We work with lots of financial institutions on their corporate climate governance. We help them either structure very precise or very specific transition plans for themselves. Sean Kamodi has mentioned that earlier, that this is sort of a new stream to look really as an institution at transition planning holistically, and to not only look at what are my sort of net zero or emission reduction goals? No, but also include adaptation, resilience goals, and in the next step, perhaps nature-related goals. That really helps, I think, in an institution to focus attention and to come up with some very concrete targets to then mainstream climate adaptation thinking, as we've already much more done with climate mitigation thinking across the institution. I give you a few concrete examples, and we can surely dig deeper into any of those, just maybe to give a few ideas what financial institutions could look at when they want to do more in adaptation finance. So we have our green economy financing facility. These are on-lending envelopes for dedicated green finance to local financial institutions in many countries where the EBRD operates, green lending lines, so to speak, where, for example, climate resilience projects for farmers can be financed, households, businesses. That may be things like drip irrigation systems, greenhouses, rainwater harvesting tanks, sustainable land management technologies, efficient cooling systems, and so on and so forth. So very practical, technology-based things that can be financed quite easily through banks in pretty much all of our countries. Then we provide tools to help with that. One tool is the Green Technology Selector. We also have it for Greece. I can maybe, when I'm finished talking, pop that into the chat and you can check it out. It's basically a white list of technologies that we have looked at, that we have tested, that are green by definition, according to EBRD standards, and it includes both mitigation-related and also adaptation-related high-performing technologies and also materials where banks, but also even suppliers or even companies that would want to look into certain equipment they'd like to purchase, they can very easily find green technologies, also adaptation-related technologies or materials, without the guessing work of having to do all the analysis themselves. More in our direct investment portfolio, it really goes across all sectors. I give you a few examples, again, just maybe to give a few ideas. One thing is in Greece, actually, the Piraeus Tower project. We took an equity commitment into this joint venture. It is a green building. We have included measures there like advanced insulation on top of several others that are more from the mitigation side. Really, really powerful. Another one is Albania railway station buildings, where we have equipped the building to be sort of a smart building with sort of very natural cross ventilation. It reduces the heat gain. It makes the comfort for passengers that have to wait in the station much more. It makes the wait much more comfortable. And is sort of a passive design strategy that can also enhance climate resilience in public infrastructure. In Montenegro, we financed installation of heat pumps as a low energy cooling solution in several educational and healthcare facilities. Again, it makes it more comfortable to be in those buildings, but it also has the nice side effect of reducing the GHG emissions and energy consumption. In Mongolia, a project I like a lot, in hospital buildings, we have implemented nature-based solutions to increase soil permeability and protect against very extreme precipitation events and associated floods. So again, ideas around maybe integrating natural systems into urban infrastructure is something really worth looking into. Agribusiness is a huge sector, highly vulnerable, as you know, of course, to climate change. We do a lot here on high water efficiency irrigation equipment, non-invasive soil cultivation gear, and then also really adapting agribusiness practices so that farmers can, for example, reduce erosion, reduce water stress, and so on. Sometimes these opportunities are not found directly in the project that you finance, but maybe in the supply chain of the clients that you finance. So, for example, we finance in Turkey, we finance a producer of canned tomatoes, and they have taken financing from us for climate resilient seeds that now the local farmers that supply tomatoes to the company, they cultivate, and that has really helped to increase climate resilience and also to reduce water scarcity. So lots and lots of examples. They're probably all worth digging a little bit into, maybe again, scope for a future clinic, maybe, or future workshop. Again, as you've said, Theodora, this is a series. So I think one can find a lot of opportunities across many, many parts of the business. As a well-diversified financial institution, our approach was to really look at it very comprehensively, very consistently at every single loan that goes out the doors of EBRD, and then really address very unique needs and very localized issues in different regions and different sectors and very specific locations. So yeah, we love to share our experiences. We still haven't exactly finished our journey. We feel we're still at the beginning. We want to do much more in adaptation finance, and we of course appreciate to learn from all of the speakers here, from you, from other banks, to really get this together. It's a difficult journey, but it's absolutely worth it, and I can only invite everybody to join us on this mission.
Thank you. Thank you, dear Maya. It is indeed the journey that we all are in together. So we do lend a helping hand along the way to make it, to have the benefit that we really need in actually implementing all these climate action benefit for our economies, benefit for our societies, and of course our environment. So now I would like to give the floor to Eleni Iotti to present the work of the EIB and have some case studies from the EIB financing on adaptation. Eleni, the floor is yours. Thank you.
Thank you very much, Dora. Thank you for the invitation. Congratulations for organizing this event. I'm trying to share the screen. You cannot see that, no?
I think, Eleni, we need to have your presentation on the screen. Instead, we do see a version of the Outlook, I think.
Okay. Yeah, you're right.
See the presentation now. Thank you.
Okay. Fine. Thank you very much again. So, I'm Eleni Iotti, and I'm working for the European Investment Bank for the team, for the advisory team of the operations department. As you probably know, the EIB group is the world's largest multilateral bank. The EIB is the Bank of the European Union. It is governed by the EU member states and driven by the EU policies. It provides climate finance. It is the utmost goal of the latest years, and it is considered as the climate bank. Going to adaptation, EIB has integrated the adaptation into its strategy a decade now. It developed the first bank adaptation plan under the commitment of the Climate Bank Roadmap in 2020. And a specific target was set there to reach the adaptation lending to reach 15% of all the climate action by 2025, and we are almost there now. The EIB the EIB tool has a range of products to offer in financing, ranging from public sector to private sector, from lower risk to high risk. More specifically, there is the option of direct public sector financing and financing to the public sector. Then there is the cover lending, where we lend to private companies. And then there are the intermediate loans through national banks, national promoter banks, private banks, commercial banks. And also there is the option of the project finance with direct finance to the project repaid by the project revenues, and which is associated to the project risk. And finally, EIF, the European Investment Fund, have some specific instruments presenting to cover high risk demand. When appraising projects for adaptation financing, and according to the experience of EIB so far, and as this issue is quite fairly new, there have been identified some main obstacles when trying to finance adaptation projects. First of all, there is still a lack of specific definition for what is adaptation. Second, although the need of adaptation climate change is there, this is not necessarily translated to a considerable adaptation project pipeline. There are issues with eligibility that are faced when screening this kind of pipelines. Third, there is, of course, and it is obvious, due to the cost of these adaptation interventions, the counterparts often require public funding and access to grants as an incentive for those kind of activities. Also, there are some issues related to loan bankabilities of this kind of projects, and of the project components are scattered, and they need to be aggregated in order to increase potential for project revenues. And finally, there is still a lack of regulatory framework and access to that. I can share with you now some specific examples from projects that are falling under adaptation financing and in the different sector of financing. There is an investment loan to a public authority, to the municipality of Lisboa, referring to a drainage system. And also you can see the percentage of the total investment reflecting to adaptation finance. This drainage system will address risk from extremely precipitation events. A second example is a corporate loan, this time given to a private firm in Germany, referring to new seed varieties that can be developed to retain agricultural productivity. And this is considered as 100% of adaptation project. A third example that I can share with you is the case of a project finance structural investment loan. This investment has been given to a project SPV, and it refers to a flood protection infrastructure, which is part of a major infrastructure investment plan and implemented by national authorities. This is in Netherlands. Again, another project in the Netherlands, this time referring to intermediate loan. It has been given to the Bank of Netherlands and then to on lending to several water boards to promote projects that can address possible risk from flood protection in the Netherlands. Finally, this is an example of a project of a finance operation in Greece. This is a framework loan, an operation done as a client to the Hellenic Republic to address the increased frequency of heat and fires and floods all over Greece, as mentioned before. And this financing operation is done to the Greek government and to support the civil protection services to buy fire trucks, rescue vehicles, and also aircrafts for their operations. I'm now proceeding to another topic. EIB, in parallel with the lending operations, the financing operations, is offering also technical and financial support to clients and to beneficiaries, and in order to promote, to support project preparation, and also to help the different beneficiaries to promote and to achieve investment readiness to their project. In that aspect, the EIB advisory can offer either financial advice in order to improve bankability of companies and to offer financial advisories on alternatives that are selected. It can offer also technical advice related to project structuring, project preparation, planning, feasibility studies. And last but not least, there is a great need, as also said before, for capacity building related to our clients' need, capacity building on technical and financial issues, and more specifically on how to address climate adaptation issues, knowledge sharing and dissemination of best practices, and also support in institutional development. As also said before, our clients in relation to EIB advisory offered is either the public sector, the local governments and the cities, municipalities, or can be the corporates, any size of corporates and private firms, and also the financial intermediaries, the banks in the countries. And of course, as I said before, the advisory is linked to financing to the bank. I can proceed now with a specific example of the Adapt Advisory platform. This is a specific platform that has built on InvestEU Advisory Hub and Jasper mandate. It is financed by the European Commission, and it offers advisory services through the whole project cycle of the project. The platform is open and advisory services can be offered to both public and private sector. And as I said before, it can apply to all the project cycle, from upstream support, covering strategies and benchmarking studies, to project preparation and implementation support of specific project pipelines, and also capacity building and awareness raising. Under this Adapt platform, I can give you a couple of examples, advisory projects that have been developed in recent years. One is referring to Greece again, with counterpart of this assignment being the Ministry of Development. There is an assignment that was developed who included two components. The national component was the first phase of the assignment, including and developing recommendations of the national and legal institutional framework, how this framework has to be developed in order to enable more and better climate adaptation investments. And as a second component of this assignment, it has been selected a specific case study, which was developed for the Heraklion Port Authority, related to a climate risk and vulnerability assessment. This kind of study addresses the current and future physical climate risk of the specific area, the likely impact on the port infrastructure, and also adaptations options and specifications to reduce these risks. Another similar assignment was developed for the island of Ischia in Italy, supporting again climate change resilience after a disaster that happened in that island. EIB has provided a financing lending operation to address the reconstruction needed, and also together with that, EIB had provided an advisory package to prepare for the better support of the investment pipeline. And finally, my last example refers to a project, to an advisory project in Portugal. Well, a climate change resilient plan was developed for the infrastructure in Portugal, comprising two stages. The first one was the analysis of the climate change vulnerabilities and risks that are met. And the second one was the preparation of the climate adaptation action plan for new investments in the area. So this was my presentation. Thank you very much for your attention, and I'm here and happy to answer any questions. Thank you very much.
Thank you, dear Eleni, for all the interesting work and the case studies that you presented us. I think you have given us a lot of ideas and food for thought for potential new adaptation projects. So with no further ado, I would like to invite Duke de Vries from Rabobank to also discuss adaptation financing, both in the Netherlands but also internationally. And also Duke will also discuss the liaison with national adaptation strategy and synergies with national stakeholders and the sustainable finance platform, which is a very crucial initiative. Duke, thank you for joining us. The floor is yours.
Yeah, thank you for having me. It's nice to join your group and to discuss what we've learned in the Netherlands working on this challenge of resilience finance. First, a bit of a disclaimer. I'm going to leave Rabobank, but I will surely continue working on this topic. And I also accepted the project to explore the interlinkages between the national adaptation strategy and the finance sector in a bit more detail. So today I'd like to share with you how we work together in the sustainable finance platform. And here the Dutch Central Bank has convened a group of the ministries, of the Delta Commissioner, the banks, the insurers, the pension funds, and the asset managers. So clearly you have the whole finance sector together with the government working on the same topic. And in the chat, we will share a link to our flagship report we issued last year, which is summarizing how we see the opportunities to accelerate climate resilience finance. In this group, we also have the scientific institutes, the Technical University in Delft. We work together with the Wageningen University and the Sustainable Finance Lab. So in this group, I've led the public-private solutions. So we explored what are the risks and how is the economy affected. And the second element of this work was what kind of solutions are there to share risk, to work with guarantees possibly, and how to attract more private capital into a market which is so far dominated by public capital. And there's good reasons why there's a lot of public capital and sovereign bonds, and it's going to remain for some time, I'm sure. But all of us, we would like to explore how to get more private capital into this market. So I'd like to discuss three things in my presentation, and I'll gladly be available for more discussion afterwards. First, to explain a bit more on how we work together, then to share with you the key lessons, what concepts worked and which didn't, and finally, just a couple of words about next steps. So on this, how we work together, we have a lot of meetings like this today, talking with stakeholders, sharing experiences. And this is not just for information sharing, it's also for getting participation. And we have the same meetings with our clients, with the real economy. And that's very important too. The economy has to change. and we should not only talk about the economy, we should talk with the economy and make sure that the financial sector is a partner of our clients to transition. Also, we have those conversations at all levels: local, regional, national, and European and global. And this is also, I see it in your program. We have participation of UNEP FI, EBRD, and also participation of European banks like ours. And this is necessary to share all of that. And then turning to the last point on how we work together, we would like to align our efforts with the National Adaptation Strategy. And it was alluded earlier today that there will be a lot of new work coming on about the national adaptation strategies, and also a European adaptation strategy will be developed in more detail. And I think that's important. There should be a game plan. So our clients want to know what's happening. The bank wants to know what is the game plan, and the game plan should be financed. There should be a discussion on how to get the financial means to do this. Turning to the second point, what have we learned and what do we think are the good concepts that everyone could use? I will summarize 4 of them. And the first one is there are good concepts right now available how to make the built environment more climate resilient. There are 2 concepts I share with you. One is developed by our government, which is a climate adaptive yardstick, which can be used to determine if any new business project development is climate resilient or not. So a municipality should actually only give a license for a new project if it's confident that the project developer can meet criteria related to extreme rainfall and heat. Any new building should be climate resilient from the start. And then there's a second concept for all existing buildings. So the Dutch Green Building Council developed a framework for climate resilient buildings, allowing every owner of a building, a private or a business, to assess how vulnerable is my building for climate related impacts, and what can I do to make it more resilient. So those 2 concepts together could cover all buildings in your country. And the financial sector is supporting this very much, that those concepts have been developed. And we will ask our clients more questions about, are you using those frameworks? What do the frameworks tell you? And then there will be an investment that needs to be made to take on the challenges for such a building. And we are open to finance those investments if the business plan is also solid, of course. So then turning to the next one, green deals for business parks. 1 in 3 businesses in our economy is located on a business park, which makes it very interesting to approach the business sectors as a group. And we developed a framework for this, and we shared it with other banks and with our government. And this framework allows municipalities, businesses, and the financial sector to work together on making the business park more green, more circular, more biodiverse, and also more resilient. And the business parks themselves can decide what they want to achieve. Many of them are working on energy hubs to reduce energy use, but many are also working on greening the business park. And we support this. And if there are investments that need to be made, banks are open to look at that. Then turning to the third example, it was mentioned before, agriculture. Of course, also very relevant for the Dutch banks and for Rabobank. There are experiments with living labs in various parts of the country, where challenges have been investigated around availability of water, salinization, stress due to heat, and you need more different kind of crops that are more resilient. And the knowledge is there, but those living labs, they want to scale up. So they seek access to finance. And this is currently being discussed also by the Dutch banks. How can we help those initiatives to make the next step, to scale up and accelerate? And finally, the example it was in one of the, I think in the EIB presentation, the cooperation with the Dutch government on the Delta program and the sea barriers, the afsluitdijk in Dutch. So the Delta program is an existing program in the Netherlands, which has a long-standing operation with very concrete projects for the next years and decades to come. And this program is being financed with public means. But in 2023, the government also used a sovereign bond to use part of the proceeds for Delta program projects. And this was very successful. And it shows, like Sean Kidney also mentioned, that there is appetite in the capital market to finance climate resilience projects, provided there's a good pipeline of those projects. And perhaps this could be also a lesson to share that since we work for many years with this Delta program, this pipeline of projects is very well developed. And investors, they can be confident to invest in it because it's very established projects. So those were the lessons I wanted to share with you. Turning to what's next, this sustainable finance platform is going to continue piloting certain projects in the built environment, for example. So you have issues with subsidence due to changing water levels. And this is affecting potentially 1 million houses in the Netherlands. And many of those homeowners are also banking with one of the commercial banks. So the banks are interested to work together with the municipalities, with homeowners, on how to tackle this challenge of issues with foundations of homes. Another pilot we are continuing working on is this salinization in Zeeland. Challenge for our farmers that need to invest in new crops. There will be a period of a couple of years. They won't be making any profits because they have to invest in the new business models. And banks are open to this and they want to see how they can help them. And I mentioned the National Adaptation Strategy. This will also be a project I'll be working on personally. How can the National Adaptation Strategy link better with how the financial sector is operating? And also, how can the National Adaptation Strategy be more explicit about what does the strategy mean for the economic sectors? And if it's clear what it means for sectors and for people, then banks can also easier finance those investments because they know what's happening, what their clients are planning to do. So all of that is happening in the Netherlands, and we're working together with the European Commission, with UNEP FI, and we're willing to share all of that knowledge with everyone. And we also need the participation of everyone to make this really happen. So I'll give it back to you, Theodore.
Thank you, dear Duke. It's been really inspiring to hear all the work that you're doing at the Netherlands and how all stakeholders come together. I think in many of the discussion, in all the discussions we had today, we saw the importance of synergies and how important it is to scale up adaptation financing and to actually also advance the capacity of all actors in the financial system to actually drive this change. So in the interests of time, as we are approaching the end of this workshop, I would like to give one question to each. And then you can take the floor in turns and close with your key message as well. So I'll go through the questions and then give the floor to each of you. And I'll incorporate as well any questions we had from the audience as well. We had more than 2,000 participants in the audience today, so we're really happy that we have this kind of interest in the issues. So, Panayoti, you see that adaptation, climate adaptation is increasingly crucial. You do see it as well in your region. What sort of synergies? We talked about synergies and collaboration as well. What sort of synergies do you envisage between actors of the financial system in general, and more specifically with cooperative banks and organizations like FEBEA? To Maya, you talked us through some very interesting projects today. A very practical question to you: how you go about finding adaptation opportunities in your pipeline of loans and investments? And also a question from the audience, from Anjanapa Janardana: if EBRD should work with startups, opening a dedicated window there. Also to Eleni, although today we discussed in a more European context, can you give us a few more, a bit more insight on the EIB support for Greece and your areas of focus there? And of course, to you, challenges and next steps. You did talk a bit about them, but what are your key messages? The key messages that you would like the audience to keep from what you discussed here with us today. And just to let you know that we will be sending out all links that were mentioned today in the discussion. So you will be getting some more material from us. So the floor is yours. First Panagiotis, then Maya, then Eleni and Yuk. Thank you.
Thank you, Dora. I will try to be short, and because I see a tremendous potential for strategic collaboration between our banks, cooperative banks, central banks, and centrally FEBEA in accelerating climate adaptation finance. Central banks bring crucial macroprudential oversight, can create enabling regulatory frameworks that recognize the unique characteristics of climate adaptation investments. Cooperative banks like our bank contribute vital local knowledge, implementation capacity, and community trust. I think that these are essential for identifying and executing effective adaptation measures. And also FEBEA, meanwhile, can provide the network effect. They can act as a knowledge sharing platform and the collective voice that amplifies our individual efforts. So I think that to put it short, I think that adapting to the challenges ahead requires not just innovation, but certainly collaboration, commitment, and a shared vision for a sustainable future. Only by working together, we can ensure that the environment we live in will continue to support our communities, biodiversity, and generations to come.
Thank you. Thank you, Panagiotis. Maya?
Thanks a lot. Yeah, so I talked a lot about what we do. So very briefly on how we do it, just maybe 4 points, and maybe this is more a teaser for a longer conversation at another opportunity. But first, really know your geographies, know your sectors. So very localized data, super important here. I really want to strongly also call, or give some good advertisement to our partners. Looking at data from central banks, of course, is super key. The NGFS scenarios to look at physical climate risks, super key. Meteorological organizations, many other data providers, where insurance sector has fantastic data that's super relevant. So we really need to analyze. Second, collaboration. We work together with the other MDBs on this. This is not a single effort, but not only obviously with the other MDBs, also with largely the financial sector. So super important to harness this collaborations. And I think this event proves how the whole ecosystem needs to come together. Third point, we have really focused our attention internally. We have published our adaptation action plan, which you can read if you like. It has really helped us to focus internal attention. Also, since 2020, the end of 2022, we look at every financing from a Paris alignment perspective, and that means not only Paris alignment with mitigation goals, but also alignment with the adaptation goals of the Paris Agreement. So that now is the hook for our climate team to look at every single project and really identify the opportunities in every single project, and then negotiate that with the banker, with the client, and so on and so forth. Yeah, I think this is very in the shortest of terms how we did it. And you had a quick question on startups. We do have a small but beautiful program for equity investments in small mode of venture capital. We also have a quite broad program to work with small companies, so SMEs or MSMEs. Our colleagues from the SME team, they do this quite regularly, both on the capacity building side, capacitating, also for green, also for climate. So there's a lot of options, even though most of our investments are obviously of a larger size. But we do some things with startups, yes. And I leave it here, but we can continue this conversation at another opportunity, perhaps. Thank you.
Thank you. Eleni? Eleni, we cannot hear you. Thank you.
Yeah, sorry, I was on mute. So very, very quickly, to your question about the IB results last year, the total amount of financement, and it was about 2.2 billion for the whole year, all related to climate, not only to adaptation, of course, and more specifically, it was related to energy supply, to construction of photovoltaic, and to upgrade of grid in the companies of DEPA and the DE. And also the climate adaptation project, it was the one I mentioned before, for the disaster preparedness of the Civil Protection Agency. In terms of advisory support, we are currently working to develop projects with the climate neutral cities and under the just transition regions for their relative projects. In order to finish and not to take your time, my last, what you asked is if I have any key message. What I would like to say is that, as we already discussed, is that it would be very, very, it is of utmost importance for the local authorities, public authorities, together with other stakeholders and organizations and entities, to take all necessary steps to prepare projects for climate adaptation in order to benefit the most of the consolidated financing opportunities that we have already discussed. Thank you very much from my side.
Thank you, Eleni. Juk?
Yeah, so my key message would be get more conversations with clients, with the economy, make everyone more aware of the urgency, but also the opportunity to tackle climate change. And this also has to be done in a coordination. So the link with the national adaptation strategy is vital. I think there's a tremendous amount of money available in markets. Sean alluded to this, but this availability of means has to be combined with real economy projects. So then you get back to the first point, talk with the real economy, with your clients, and then we can work together on delivering on this. So thank you very much.
Thank you, Juk. Thank you. And it's my turn now to thank all of you for being with us today, for your participation at this workshop. We had the opportunity to discuss barriers to adaptation finance, challenges of adaptation finance, We talked about the deep uncertainty, the assessment of adequacy and effectiveness of adaptation projects. Also, in the first session, we saw the time sensitivity of adaptation and the importance there of getting the triple dividend. We talked about financing frameworks that are important to scale up this financing and collaborative initiatives like the Resilience Investors Collaborative, the Responsible Banking Association Adaptation Group, the Principles for Responsible Banking, and how the financial sector is taking action to mainstream adaptation finance. We talked also about resilience taxonomies and how crucial it is to identify the resilience projects that we should be financing. And of course, in the second session, we showcased in practice how to finance adaptation projects. We had some very interesting case studies, thanks to you all, also relating to agribusiness and water scarcity. We discussed the importance of reapplicability potential of projects, how we need to have a place-based approach, and how we need to advance the capacity of all. And of course, the importance of synergies among key stakeholders. We had excellent examples from the Netherlands and the Sustainable Finance Platform. And we also talked about the role of financial institutions on adaptation. We have also the example of the Bank of Greece there and the work we've been doing since 2009, also on research, but also contributing to policy making and to active projects like the Life Adapted Greece that this series of workshops is happening in the context of. So in closing, I'd like to thank you all for joining us today. I have to, I did a mistake earlier. We had an audience of more than 200, not 2,000, as I was told by our excellent team here at the Bank of Greece at the Climate Change Center, which I really like to thank as well Yannis, Eleni, Katerina, and our communications department for planning this workshop. Of course, we will be following up with links to the material shared during the meeting and keep you all informed on following initiatives and next up in the series. Thank you.